6 months ago or leading into that, the market sentiment is, hey, rates are going up, then it seems like all of a sudden the narrative flips.
Last year we were staring down the barrel of rate cuts. It's definitely not a hardened steel barrel. It's almost like it's made out of feathers at the moment. They're all just kind of sitting on the sidelines. Once bitten, twice shy would probably be the overbearing feel.
I'd have to disagree with your sentiment. Everyone else who sat on the sideline, like we just said, who's just going to flood back in. You can go to an open home and you can be, maybe you're the only person there.
Well, it's been a bloody soup sandwich, mate. It's all over the shop. It's been...
Welcome back to Money on the Mic. This is episode 5. I'm joined with my co-host, Brodie Gilbert, to talk all things Australian property and finance. Brodie, today the RBA meets, so it's a near certainty that the rates are going up today. So the market's priced in 90% probability that it's going up. So let's pencil that one in, that it's already happened. I can't help, but we've deliberated this before and off camera and whatnot, just before and in the weeks leading up to it. The amount of times we've seen in the last few years where, 6 months ago or leading into that, the market sentiment is, hey, rates are going up, then it seems like all of a sudden the narrative flips, then rates start going down. If we bring it back to, if we just wind the clock back 6, 8, 9 months, leading into Christmas, October, November, the market and therefore everyone who essentially picks up those headlines and just reads that narrative and believes it, was in the train of thought that we were coming into 2026 with 3 rate cuts. Now we're staring down the barrel of 2 going on 3. And the possibility of many more. So, tie all that back in. We've said this before, economists cannot really predict accurately more than 3 months in advance. What happens if today was the last rate hike? Let's say if the narrative, let's just say the market is wrong. Let's say if today is the last rate hike. How do you see it? What's your thoughts? How does it impact where we are now?
Yeah, it does. I mean, it comes down to, like you said, sentiment. And when you said we're staring down the barrel of 2 or 3 rate increases, exactly the same on the other shoe. The shoe on the other foot. Last year we were staring down the barrel of rate cuts. So that barrel it's definitely not a hardened steel barrel. It's almost like it's made out of feathers at the moment. And I feel like the sentiment probably in the last 5 to 6 years has swayed quite dramatically, as in, it could be even quarter to quarter. It goes from, we're in the clear to we're not in the clear. And this year has kind of proved that as well with the oil crisis, we can call it, I suppose. People are probably calling it all sorts of different things, but it's effectively an oil crisis that's increased inflation everywhere in the world. So starting back when, again, we talk about COVID a fair bit, when COVID, or, very, very fresh scars from COVID, still everyone's kind of very on edge. Whereas prior to that, like, the rates didn't really move anywhere near as quickly and therefore probably the sentiment didn't really move as quickly. Whereas now we're seeing, it's almost like a sentiment-based or a feel-based move, not so much even throughout the economy, but even with the economists and, the guys that are paid the big bucks to make those calls are almost just making these calls, it seems, on feel. So who's to say our, these rate rises are going to happen? Like, it could, we could get shocks on the other side of things where all of a sudden, and we'll probably talk about it throughout our discussion today, but unemployment becomes a real factor and rates do need to cut. So it's not a certainty. It's more than likely a certainty today, but it's not a certainty that will happen, over the, those 2 or 3 or even more rate cuts over the next sort of 6 to 8 months. It could quite easily turn.
Okay. So if we look at let's call it a hawkish perspective. So Westpac's economist and Westpac's team have priced in the RBA increasing the rates to 4.85% come August. So again, that's probably out of it is out of the big four banks, the major banks. That is the most hawkish projection. Let's say today's the last one. Let's say today they raise it. Again, we price that in 90%. That's all but a certainty. That happens today. And if today was the last one, given that market sentiment to right now as it sits is the lowest it's been since around COVID time. So people are sitting on the sidelines, buyers are nervous, there's less people going to open homes, people are delaying purchases. No doubt it has, 1 week from today will be the federal budget, which we all know is basically your second Christmas, mate. You stay up there all night. You can't, that's right. You can't sleep
Come
that
on,
night
kids,
and the next
jump
day. That's right. You studied accounting, didn't you? Is that right? That's
that's just to keep me abreast of everything, so I can pretend.
Yeah, it's those the things that excite you, mate. So given the fact that the budget is a week away, we've got as we say, a lot of let's call it people sitting on sidelines, not necessarily all nervous, but sitting on the sidelines just waiting to hear, right? Waiting to hear about today's result, waiting to hear about the budget next week. And the headlines every time someone Googles interest rates, all they're seeing is some fair, let's call it, when I say hawkish on the rates for the market in terms of how that impacts on the market, it's more of a bearish, it's so negative connotation to the market. So again, if we wind the clock back 6 to 9 months before Christmas, everyone was saying cuts. Now they're saying, and they were wrong. They were simply wrong. We got into the new year and straight away they raised it. So they couldn't have been more wrong. So now let's say today's the last one. Today's the last rate rise we're going to have this year until we go into a period of whether it's just, the RBA sits there idle and watches or they start cutting. So let's say today's the last rate rise. How does that impact market sentiment going forward? How do you see the Australian property market? I know that's quite broad if we're talking about it as a whole, but from where the experts are kind of forecasting it, what would change if today was the last rate rise?
Yeah, and taking out the budget side of things, because I think what's happened in the last couple of months is that we've had the sentiment, or the, let's say, slow/negative sentiment around inflation, but also there's, as we mentioned I think last episode or a couple before, about the budget is heavily geared this year, it seems, to property investors, whereas in the past it was basically off the table. Also, Elbow said anyway. So there's a bit of a combination of two potential big calls, in a space of 2 weeks. So a lot of people I've found, or we've probably found a lot of clients recently, they're all just kind of sitting on the sidelines, which is why we're seeing, probably less people putting offers for, less people lining up. It's not to say they're not ready to go when they know that information. It's just hard to make calls on speculation at the moment, especially when it's pretty well all negative in terms of investment. So I think what would probably happen is people would want to see out, and it's getting towards the end of the financial year. Not that makes a huge difference for general day-to-day investors, but a lot of people with that kind of mindset do like to, start the new financial year fresh or something like that. So, with putting my accounting hat on, it's the end of the new year sales, and that's when everyone gets a bargain, whether that's in property or not. But I think what we'd probably see is if it was the last rate rise, taking all the budget issues or potentials out of it, people would sit for a couple of months, I would suggest, and want to see, this quarter, which ends in June, this quarter's inflation, because we get CPI every month, but the overall actual headline inflation generally comes every quarter, which is only, then reported in July, or, the month after that quarter. So I think we'd see a lot of people kind of sitting for a few more months first, waiting to see if actually, this time around there is some positive outcomes with inflation. because that is exactly what happened only 12 months ago. And they cut the rates around this time last year, and everyone was in the clear. Yep, everything's going to explode again. And 6 months later, it totally changed, literally totally 180 flipped. So people remember that. So I think we'd see a lot of people still sitting on the sideline for a couple of months, if not 3 to 4 months. And then from there, depending on what everyone's looking for, whether it's shares, property, investing, then there's still definitely is, like we've mentioned, an undersupply of property. So the fundamentals of the market are still there, and the market demand will meet those fundamentals if everything stabilizes in terms of rates. So I think that's probably what we'd see in the shorter term. Longer term, I mean, we can speculate what would happen there.
So you're saying if let's say tomorrow the headlines go from rates are rising, everything's in turmoil, we're all in trouble, we can't eat anything, we can't drive our cars because petrol's $1 million a litre, we got to start walking, eat beans and rice, drink water sparingly. We go from that to rates are going down, everything's great. You're saying that there wouldn't be a mass, that we wouldn't go back to seeing what we've seen 6 to 9 months ago, where there's 20, 30 people at open homes, people sort of rushing, a degree of FOMO, all these things coming back to the market. Do you think that they're going to pause
instantly? Then, well, we're not going to get those headlines straight away. Like that is the last.
But if we do,
I still think people would wait. There's not a lot of trust in our government at the moment, it seems, again, based on sentiment. So I think that they would still pause. I think, once bitten, twice shy would probably be the overbearing feel. I think people would wait. They wouldn't rush out. There would definitely be some people rush out because, the investors that generally make the most amount of money are the ones that, act in times of fear, as we know that. You've mentioned that, and we've mentioned that, and it's you read about it all the time. But I think the majority of the market would still probably, at least wait a couple of months, I would imagine. I would think anyway.
Okay. You have I'd have to disagree with your sentiment, but that's varying opinions are always good. I think that, FOMO is real when it comes to this, and I think Australians' affiliation and love of property is not unknown. I think the moment that the media, the sentiment, and it's all driven by media, it's all driven by experts or people, let's go, people like us or people with other shows and podcasts and stuff like that who help drive particular stories or help tell you what's happening in the market. I feel like the moment the narrative flips, the moment that happens, so the moment the majority of media and news outlets, YouTube channels, sources are starting to say, hey, we've hit the peak of rate cycles, we're going to now either possibly get it, even if it's we're not going to do anything, but we'll possibly get a cut in 2027 or 2028, and this is how it is. I think that all the people who've been sitting idle, let's say in the last 2, 3, 4 months, will flood open homes again. I think they'll really rush back out. I think, similar to levels what we had last year and possibly the year before, I think we're just going to get inundated again with people in open homes. So I think, I understand what you're saying. I think like the more cautious, tentative investor may sit idle. Like maybe they'll sit into the new financial year. I think that probably is not the majority. I think the majority is going to really, like I said, bullet a gate. I think that they're going to come back and storm. Now, that's very dependent on the market sentiment. It's very dependent on what the news and media outlets are coming to say. If it is still negative, if it is still rate rises, we're in this market, we're in inflation. Like I said, all those things I just mentioned before, I don't think that anything really changes from what's happening at the moment. But I guess the big thing here is like how many times, and we've been doing this a long time, how many times have we seen the forward-looking projections 6 to 12 months in advance say one thing, only for 6 to 12 months to go by, and that didn't eventuate at all. Even if I think about say COVID times and the big four banks putting out their prediction, their base case, and even their bear case on property prices. Some of the big four banks went up to 40, 43, I think, 45% property market downturn as a worst case, but the base case around about 10 to 15 to 17%, and we got about 25% in the next 12 months. So they're only wrong from their worst case by about 65%, which is, shit. And then they're only on their base, their middle case, they were only about 45% off. So, they're terrible. They are absolutely hopeless at predicting anything. The big four in advance, in my opinion, they are wrong more times than they are right, and they're not even close most of the time. So, in terms of rate rises, again, we're not sitting here to predict that they're necessarily going to stop. I think though, if they do, it's a really oversold, and it's really the key thing driving. It always does, but it's really driving the headlines at the moment. So, if it bleeds, it leads. So apparently the RBA is bleeding hard. Hey guys, Darren here. Money in the Mic is part of Fund. Fund is a team of highly skilled mortgage brokers and finance professionals who are pretty much scattered in every state and territory across Australia. So by all means, if you want to know more information about anything said in the show, or you've got a personal question or anything, please scan the QR code on the screen or go to the show notes and you'll find some more information how you can connect with us. All right, thanks very much, and back to the show. I really struggle to entertain the fact that, we've got those sort of continuous rate rises. Today, it's a sure thing. Beyond there, factor in another few more is really hard to fathom. A lot of the data we've been pulling out, as you know, then start to tell us where distress listings start to rise. Those markets are around Sydney, they're around Melbourne. They're the two markets to start to dominate those particular areas. Especially if we have another couple of rate rises from here, 2 to 3 rate rises. So, then you've got a whole modicum of things. So if you factor in, like you've touched on, unemployment and a set of other figures that are floating around, the war in Iran, although we get up and down narrative each day about ceasefires or not. Tying all that back in, the rate rises to continue the way a lot of the sort of doom and gloom is happening, predicting, would be somewhat catastrophic, and it's really hard to see.
Yeah, and I think those things, I think that those particular instances where we are 12 months down the track compared to where we were, and we saw everyone, rushing back out. I just think that there's more people now that probably have less cash, have more because they've been sort of riding that wave of higher rates, and had more cash or more equity for cash because of the prior lows. Like there was significant lows, and we still had people coming out at 2-3%, low 2 to low 3, that band, depending on when they locked in fixed rates, even into last year. So there was still people with money, whereas I think, and there are still people with cash and equity, and borrowing can still happen. I just think that there's more things going around now to keep that sentiment at bay for a little bit longer than, if the headline was rates are done, because I don't trust what they say, and I'm not a professional. And my sentiment around the market at the moment, based on, some of the things that we've looked at, is a lot more negative than it was 12 months ago. And I know that we pay attention to this probably a lot more than, people that aren't working in a finance role. But I think that is sentiment, right? It's the media, what the media pushes. And I think a lot of people have been burnt by the media in the last, 150 to 200 years, but in the last 12 months, a lot. It's been a bloody soup sandwich, mate. It's all over the shop. It's been rates up. Well, starting from back when we had the last governor in, we're definitely not raising rates to 6%. And then, we're not doing this. We're going to, it's just a shit fight. And I don't know, I just think a lot of people are sick of it at the moment, and the sentiment is really a lot worse than it was 12 months ago. And I think that FOMO would come back for sure, but I just couldn't see people. There would definitely be a segment of people jumping in. And yes, Australians love property, but I just feel like, just from talking with clients recently, prior to rate rises at the start of, where the rate cut started last year, speaking to them prior to that, they weren't waiting then. People weren't waiting. They were just like, it's going to happen. Like, these rate cuts will happen. And now it's like, I don't know. And even if that was the headline, I just don't know people would believe it immediately. If the rates did stop today, if this was the last one, who would be the winners? Who would benefit out of these kind of, knowing that and say everyone did jump straight back into the market? Who would win?
Who depends who's positioned to win. I guess, like, if you're still thinking about entering the market, or if you're wanting to enter the market, whether a first home buyer, investor, upgrade, or anything, if you sit there and do nothing and not prepared, and the sentiment changes, the sentiment, like the media, it can change. Like we said, we've already said it can change instantly. So and this does play into what we do. Obviously, we own a broker firm, but speak with your broker, get prepared, get pre-approved finance, get your finance sorted, get ready. You don't. I think there's going to be, let's just say that the narrative changes in the next couple of months. We've already mentioned how quickly it can change. Let's say it does change in the next couple of months. Presently, there's going to be a cohort of sellers sitting there, either they haven't sold, haven't got the price that they're expecting, they're starting to change their expectations, or they haven't listed because of these things as well. So there's buyers and sellers sitting on the sidelines. So let's just say you are one of those buyers, and you are somewhat proactive, and you make you get your finance sorted, you look at the long-term fundamentals of buying a property in Australia, look at everything else, forecast beyond the sort of next 6-12 months. I mean, those people are going to win. The people who take action when there's a little bit of uncertainty, the people who don't listen to today's headlines or let them sway from their goal, if their goal has been for years or been a year to buy a property. If they were super keen to do that in, September, October, November, they just weren't ready. And now it comes to May and they're reading a couple of headlines going, oh, maybe I shouldn't. Think about how long you were in the property market for. Like, think about, is it something that you're going to buy and flip in 3 to 6 months? So then maybe those people can stay idle and stay on the sideline a bit longer. But, for everyone else, who's practically everyone else, and if assuming they have a long-term perspective, which everyone should on property, then they should be ready to act now. They should stay prepared. They should, speak to their broker. They should, renew their pre-approval. They should make sure everything's sort of ready to go. They should still be inspecting properties. Just don't buy into just the fear-mongers that are getting out there right now and going, hey, the property market's, in trouble with blah, 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 blah. Again, could there be some short-term pain? Yes, absolutely. It doesn't take much to flip the narrative. It takes, if the war all of a sudden comes to a peaceful resolution and a good stop, and, the world returns to somewhat normal, like we had before, if markets stall or start going back, if rates stall or start going back down, if there's some incentives, if the budget isn't as bad or, isn't as scary as what people are potentially predicting. I mean, no one likes the unknown. So if these things sort of happen, if they play into it, and then people start, again, that flips over. You've got people you've got the same amount of, you've got more buyers who haven't entered the market. So if you thought previously was bad, when there was 20, 30, 40, 50, depending on the location you are, groups of people to an open home, and you get 5 to 10 offers on a property in a really hot market, then you're going to get the same thing. So right now you don't have that. You can go to an open home and you can be, maybe you're the only person there. You can definitely you can get a park closer to the house you're trying to buy. That's probably the main narrative I'm trying to push here. So quite often it's, if you start looking at investors like Warren Buffett, Charlie Munger, all those sort of places, not going to quote them all, but essentially all those people rather, if the best time to buy is when there's a bit of a fear in the market, they say never waste a good chaos. There is a small sort of chaos brewing in the in the media more than anything, but in the market at this stage. So you've always got to double take and think about if someone's sitting there telling you to buy, especially for the people that sell you the money. But where we've seen good investors and good people capitalize on the market is in a market where people are nervous. Like, those people that transacted in COVID when that the fear, like we said, from the big four banks and a lot of people were, hey, look, the bear case and the base case were really pointing down. They were really poor, and we know that a lot of people got going. Then a lot of smart money really entered the market, and those people have flourished. They've made an absolute ton out of that. We can wind back to, depending what the market overall pre-COVID was very much independent in different sections. So, Sydney and Perth, for example, didn't correlate. They didn't look. Perth had a higher property price pre GFC than Sydney. That market was completely uncorrelated for the next 10 years, but. We've seen some negative growth in a few sectors back in 2017, 2018. Again, if you read into the fear, you said, "Oh, you didn't do anything." If you sold, if you went to cash or whatever it is back then, you would be kicking yourself. I know there's a lot of things that played into it, a lot of things that were positive. That potentially could be argued that can't be re-injected into the market, but the one thing, and there's many things, there's many positives to like about it, but silently as all this is going on, we're migrating more and more people to the country. January was a record month. February, I don't know if the data was out before we recorded this, but I think it is. I think they estimated around 3,000 people a day in February, which is closer to 90,000, which would be the highest month ever recorded on migrants into this country. So they've got to live somewhere. So look, migrants, similar story, but I guess right now you're probably getting a discount on an asset class which has been somewhat, it's just been probably one of the most safe haven assets. Certainly domestically, but globally, if we're looking from the outside in, over the last 30 years, we can argue a lot of reasons why that is. We've gone traditionally from a one-income household to two. There's a lot of other things, tax changes, reforms in Australia, growth, migration, a lot of things, all positive talk, pointing towards the market. But, overall, our country is still very young. We can balloon a lot bigger than what we are now. We can build up, we can build out. We can do a lot more. There's a lot of growth to happen in Australia. And I think if you're buying into these short-term headlines where it's, hey, rates are going up and it's all doom and gloom, then, if you sit there idle and you start to get confident, only when that narrative changes, only when the news starts to say, hey, we're at the peak, we've gone past all the rate rises and now it's come back again. If you sit there and wait until that happens, and the same thing's going to happen like it has in the last 30 years when you go to buy, well, not last, there's certainly in the last 10, 15 years when you've gone to buy a property when everyone else is sort of excited and the sentiment's ticking up and the confidence is up, then you're going to be competing amongst a lot of people. It's a good time to act, is basically to summarize all that. It's a good time to be ready. It's a good time to be speaking to your broker. It's a good time to, start to, if you've stopped going to open homes, don't, start going again. Start looking. Going doesn't mean you have to buy. But you can see that there's going to be less competition, and less competition is great if you're a buyer.
Yeah, and it's good.
Thoughts, Brodie?
Yeah. Yep. Thanks, Daz. You can breathe now. I think, that still going, like clients we speak to all the time, regardless, it's even if they're ready now or they're ready, more so if they're ready in 6, 12, 18, 24 months, get out there and talk to agents, talk to people, talk to people in the industry, because you kind of, especially if you're setting yourself up for a journey in property investing is you need to be in those situations, feet on the ground, to know how agents talk, or how that sentiment flows through, not just from the media through to the agents, and also seeing what people, feet on the ground in the open homes, if 5 people are there or 50 people are there, and what's driving that, because it gives you knowledge as a property investor or a long-term property investor to go, all right, well, in 10 years, if we're in the same situation again, 15, whatever it is, you've seen that, you've experienced it, because you can read all the books, you can listen to all the advice, you can hear what your dad did or your granddad didn't do, but until you've actually experienced it, it's very hard. I mean, me personally, unless I've experienced things, it's hard to go, all right, well, that's what it matches. Yes, property goes up over time, but in these little midst of chaos, what did I see there? What did I learn there? So we always urge our clients to just keep getting out there. If property is your game, it's getting out there, getting a feel for it, because you will be more comfortable in those chaotic periods. And basically what you touched on, if you're ready to go and you've got finance approval and you're looking at things fundamentally, the market shouldn't really, or the media or the hype or anything like that, as long as it's not, unaffordable for you to put yourself into, it shouldn't really affect what you're doing, because markets don't move as quickly as they have in the last 5 years. And I think that's where a lot of people have lost touch. A lot of new agents in the industry, a lot of new brokers in the industry, a lot of new investors in the industry, that they don't realize that, property does actually grow slower over time. So if you look at it fundamentally over a longer term, and you can set your cases, you can look at what things are going to look like in 20 to 30 years based on, worst case, reality case. And if you want to look at best case to have a little internal party, that's great. But if you're winning best case, you don't have to worry as much, I suppose. It's good to talk to those people and get around it. So fundamental investors, definitely are the ones winning, as you touched on, and people who are ready to go, that look at it from their actual point of view and how it affects them. There's all sorts of different things that may affect them, but a lot of things don't, like you mentioned, don't eventuate. So you can look at things through a very negative glass and go, this might happen, but it also might not happen. And, time in the market versus timing the market. We say all the sayings all the time, what people say, over time, assets have appreciated or do appreciate in value, money loses value. So where do you want your asset? And things change. Like you said, you can go into cash for a short amount of time, but over time, cash devalues, assets increase in value. So, on the other side of that, who would lose in these situations if the rate started dropping? Who's the losers?
Who's the losers? Oh, I guess, just you play complete contrarian to what we just said. So the people who wait, who buy into it, who don't act. So that's the easiest. Like, if you are a first home buyer, you're wanting to buy, you're wanting to enter the market. It doesn't matter, first home buyer, upgrader, downsizer, it doesn't really matter. If you're wanting to act and you're in a position to act. So like I appreciate there's a tough market. There's a tough market in terms of, saving, Australian property as a whole, not to take anything away from this podcast, but the Australian property market as a whole, relative to our incomes, is just expensive. Has it not been for 10, 15 years? So, people can argue, oh yeah, it's expensive in the global scale. Absolutely is. But again, we live in probably I personally bias, of course, but best country if you look at all the metrics and livability conditions in the world. We also don't have to share it with any neighbours where we think that, we're going to get invaded, a whole bunch of other shit as well, right? So we've got perfect living conditions, we've got great weather, all that stuff. So won't drill into all those non-monetary things, but a lot of people want to live in this country. Why wouldn't you want to live in this country? It's a great place to live. So if you're so the people who lose out, the ones who don't take any action. So if you are in a position, so we're not talking about the people still saving for the deposit, of course, or have to rob anyone to get into a position. But if you are in a position, and if you're not acting because you think that rates are going to go up, or you think this bearish sentiment around property, then you've you've really got to sort of forecast and look forward. The people who are going to lose are the people who are going to look back and say, in X amount of months, and we don't know what that is. Let's say 3, 6, 9 months time, when say the sentiment is positive, the narrative change, rates are coming down or they're stagnating, or there's positive things for the market. Those people are going to lose because they're going to go, I should have, I wish I could have, should have, would have, could have. We all know that. But those people who could have, would have entered the market, and the goal is to enter the market. Like the goal is to buy a property. And let's just say, even say for first home buyers, in particular, if you're sitting there idle because of this, and you go, I might not enter for 3 months or 6 months or 9 months, it's hard to see that it's going to make a massive difference. Even if the price did come off a little bit, even if the price come off 3-4%, you've still got additional, obviously, rental costs. You've still got other things attributing to your everyday living. And then the time that, anything that you perceive as a discount, the time you turn around, go back into the market, you've got everyone else who sat on the sideline, like we've just said, who's just going to flood back in, and then just compete for those prices and probably erode anything that you thought that you saved on not entering the market. So, the best time to buy a property was 20 years ago. The second best time's now. I think the smart money is getting ready. It stayed ready, to be honest. If I think about our business and our smart investors, they're buying, they bought, they are actively looking. These things rarely affect them. Especially if you plan as long, anyone who's too short-sighted, then property's probably not your game, and you should have stopped listening to this podcast, at the start. But anyone who is long-sighted, long-sighted. Anyone who
we'll look at, we'll look at crypto investors later if you want to look at short-sighted. You might be dropping out, Daz, but basically it's a matter of stay ready, be ready. Speak to your broker. Hopefully it's us. Get yourself ready and stay ready. We can look at situations as they are right now. If rates do go up, what that looks like in terms of borrowing capacity, repayments, and potentially if they go down, again, that's a better case scenario. But and then what kind of prices you can look at. We can get everything in front of you to give you as an investor, as a first home buyer, as first time, second time, third time investor. We can map all those out, and you can get that idea of comfortability, because that's really what sentiment is at the end of the day. And then you can make your decisions from there. But in action, like never heard a client say, "Oh, I'm glad I waited." Like I've never heard anyone say that. So it might come. We've been doing this for a while, but we haven't been doing it forever. And it's been, seeing the markets move up and down in that amount of time, and it's going to keep doing that. That's what it does, because markets have corrections. They, we mentioned in other earlier podcasts that, whether we think there's a boom or a bust and bust coming, like touching on what you mentioned as fundamental investors are the ones that win, and we are in a fundamental situation in Australia at the moment of an undersupply of property, and we have a lot of people coming in. So take everything else away, we need to house people. That's probably as far as most people need to look. We need to house people. What do I do to basically win from that situation? Be in property, whatever that looks like, whether it's up, like you said, up, down, or not down, up, sideways, regional towns, different states. Talk to professionals, talk to us. But I think, we can go on and on about different scenarios, but I think it's probably, you've probably had enough of technical difficulties. So anything else you want to add?
I don't know if you can hear me anymore. So I
can.
Yeah. thanks for listening, anyone who did stay for the full podcast. We do want to hear your overall what you think is happening in the market, what you thought about this podcast. Any questions you have, drop in the comments. Get in touch with us. Sometimes the questions you have, the comments you make, whatever it is, it drives our anxiety. No, it drives our next podcast topic. And then we do read them. We do strongly consider them. So thank you for anyone who has commented, who has liked and subscribed in the past. Do so if you find value. I mean, if you're seeing this for the first time, it's because your algorithm, YouTube AI, basically said that what we said will resonate with you, or you'll get some value out of it. So hopefully,
or it'll trigger you, and then you can comment either way.
Yeah, trigger us and roast us, and let's see. Yeah, let's go on the cycle.
And
cool.
Share with
Thanks
a friend
again.
also. Share it with a friend. Don't just like and subscribe, because I've had a few people that have shared it on, and some people are getting some value.
Yeah, thanks, bro. Thanks for the kick there. So thanks again for joining us. We will be back next week, for now, have a good one. Thanks.
Thank you.